Hello everybody and welcome to Heat Maps. My name is Victor and in this video I would like to share my investment strategy with you. And first of all, I have to tell you that I am not a real estate agent, I am not a guru, I am just a beginner investor who is just starting my journey in the investment property area, and so far I developed my own strategy which I'm trying to follow, and my strategy is, I think, a little bit different to most of the other strategies. I'm not saying it's good or bad, it is just my personal choice, and I actually do realize that I could be totally wrong in what I'm doing, but so far in the last few years it seems to be working, and I'm still learning. I hope that my strategy will work, but also I'm flexible, and maybe tomorrow I will change my mind, I will change something in my strategy. Okay, let's get to it. First point, I decided that I am investing into townhouses. So there are options like apartments, houses or townhouses. I do like houses, but for some reason new houses, and I'm interested in new houses, they're always located somewhere in like really far away area. Apartments are located in a good area, but there is so much oversupply of apartments, and I'm a bit scared of investing into like brand new complex, and then all of a sudden there are more and more coming up in the area, and then I'm having a lot of competition, and I don't like competition. So when I'm choosing townhouses, I'm choosing a good location, which is my next point. By good location, I mean area where there is not much of supply of other construction. It is well-established area with lots of coffee shops, restaurants, nice lifestyle, maybe beach, maybe universities, some sort of activities going on. It should be a place where it's good to live. It should have a really attractive lifestyle. So this is not like house and land communities somewhere outside of the city. Then comfortable budget. So I don't think it is a good idea to invest to the maximum. For example, if your borrowing capacity is $1 million, I would stay within like 70% of it, because what happens is they could raise interest rates and you were planning to settle on one interest rate, they could raise it, and then you can struggle to get your loan. And it gets me to the next point, which is I'm investing into brand new, pretty much off the plan constructions. Off the plan is not a popular idea amongst investors, but I do like it. Off the plan, normally when people say off the plan, they think like either apartments off the plan or it's house and land package off the plan somewhere like really far away. But I'm not interested in any of these. I'm looking into a well-established area where a builder, actually not a builder, a developer is promoting a new, normally townhouse complex of 20, 30, up to maybe even 50 townhouses, because maybe they would like even to build apartment complex, but because of the zoning they are not allowed, and everything they can do is just townhouse, just to maximize the profit. I understand that. Next thing, 5% deposit. This is something new I learned recently. When you're buying off the plan, it is quite reasonable and realistic to convince a seller, developer, builder, whatever, to reduce the deposit from 10% down to 5%. And in my strategy, where I put a deposit like 1 or even 2 years prior to the completion, I'm saving money today, and I'm putting like my deposit today, and I am planning my settlement 1 or 2 years ahead. So I have time to prepare, and more importantly, during this time, I don't have to worry about anything. So I used to own investment property where there is so much headache with tenants, so much bills, so many headaches where you have to pay strata, you have to pay council fee, you have to pay for the water. Something can break down, and there are lots of emails from the agents, and after a couple of years I realized I don't like this. I would prefer to put my deposit today and forget about the whole thing until like 1 or 2 years ahead. And then in 1 or 2 years, market moves, and it moves not only by itself, but also as completion gets closer to the, as a progress. So again, I'm investing over the plan when it is just the idea. And then in 1 or 2 years, it is a build complex. So initially risks are high, at the end risks are low. And this is what boosts the price even further. Okay, what else? Queensland preferred. I prefer Queensland for a few reasons. First one is the massive population growth. I think Queensland is #1 state that receives the most amount of internal migration. I think over 30,000 people moved there like in the last year or so. I'm not 100% sure, it's all over the news, but to me it's all I need to know. People are moving there. Secondly, Queensland has the lowest stamp duty. When you're buying a house, for example, for like $500,000, Queensland will ask you around $15,000, where, for example, Victoria is the most expensive state in terms of stamp duty. They will ask for like $23,000. So another little benefit. Also, just like Queensland, it has a nice lifestyle. I don't mind traveling there. I've seen a lot like this idea of buying interstate without even going there, and honestly, I don't understand that. Why not? Just buy a ticket, fly there. You're not gonna spend much money. Like my last trip, I think I spent $120 on tickets. It's like $60 one way. Okay, you will need to hire a car, maybe some accommodation, but hello, you're coming to Queensland. It's a beautiful sunshine state. Just enjoy your time and make use of it. Check out some properties. So, like you're combining your little vacation with your investment, which is like a business trip. Settlement every 6 months. So what I do is I am planning all my settlements to happen every 6 months, because in my eyes, settlement is money. If settlement happens successfully, this is where you make your money. And pretty much there are 3 major events. First one, you're paying a deposit. Second one, you're settling on a complete property. And third one, you're selling the property. Yes, actually, I don't mind selling the property. I recently sold one and I have 0 regrets. Those people who advise not to sell, they think like, why would you sell? Because you will have to pay capital gain tax. But look, here in Australia, we have a big advantage that we have a 50% discount on capital gain tax. Let's put it into numbers. Imagine if you bought a house for $500,000, $500K. After some time, you sold it for $700K. You made $200K profit. From this money, after, I'm assuming you own the house for at least 12 months, $200K with 45% tax, it's gonna make like 90, and it's gonna be half of 90, it's gonna be 45K. Sorry, I was wrong, it's 45K. So you made 200K, you paid 45K approximately in tax, and everything that is left is all yours. This is your cash today that you could use, like it's cash on your account. It's not a line of credit. This is just spend it, buy yourself a nice car, invest it into other properties, go travel. This is the money you earn. So that's my opinion. I think that's pretty much it. Thank you for your time. I hope it was interesting. Goodbye.